Rahul Chadha as well joins in on the show right now. Rahul, hi, good morning. Since we spoke just a few days back, Rahul, the world has completely changed. Not just 100, now we're staring at $110 to a barrel on crude. Where are we headed next, Rahul?
Yeah, so I think what commodities are showing is this uncertainty which has come because of sanctions on Russia. And near term, look, it can go higher, but then our view is once it goes beyond 120, 125, there is going to be a demand destruction. And from a market perspective, near term, particularly for India, which is a big oil or crude importer, it can be choppy. But for anybody who has a 3 years time frame, I think next 6 months would give good entry points. Because time and again we've seen that, look, it's the entry points for good businesses and that matter in terms of returns.
Okay, I'm going to come to what are the entry points and what are those good businesses in just a bit. But Rahul, we were just chatting with another speaker just a short while back, and he continues to maintain that this is at best a deep correction in an otherwise intact bull market. Having said that, from those March 2020 lows, the landscape of macroeconomics for the markets have completely changed, be it with inflation, be it with the interest rate trajectory, crude, what have you. Do you also believe that this is just a correction in an otherwise intact bull market, or do you think now with the dynamics changing and the landscape just so different than 2020, this could very well mark the peak of the bull market?
Okay, so our view is that we are beginning of a fresh cycle. Look, if you see in India and most parts of the world, except China, for last 7, 8 years, it was not an investment cycle. In fact, what happened in the last decade was that China had overinvested and rest of the world had underinvested. And we are seeing a reverse of that as China goes through this course correction where they are deleveraging, cutting back on the excesses in the property cycle or other sectors of the economy. The rest of the world is encouraging investment. So this is still a fresh new cycle. What's happened is this bit of an overheating, which has come through because of all the supply bottlenecks which happened because of Delta variant last year and some of these issues which are happening in Ukraine now. But as things settle, which we believe should in next 3 to 6 months, inflation should be in a lot more palatable level, and then people will be less worried about central bankers. See, central banks are deliberately behind the curve. They want to keep real rates negative, whether it's US, whether it's India, because they want investments to pick up in the real economy. So I think that trend still continues. Deflation is a bigger worry. Job creation is a bigger priority here for central banks in Asia, particularly India, than inflation. Inflation, we still believe would be a near-term issue. It's not going to be to the level we saw 3, 4 years back. It's going to be a much higher inflation, but definitely it's going to come down from the levels we are seeing today.
This is Nantara joining in now. So if you think that inflation is a short-term trend, are you not tweaking your portfolio for this pro-inflation trend that is panning out and just the numbers that we're seeing, for example, in the energy markets, the commodities, metals?
Okay. So from our portfolio for last kind of 12, 18 months are inclined towards this new investment cycle, the cyclical recovery. So it's overweight banks, industrials, etc. What we did after a strong rally 3, 4 months back, we took some money off these names because they were looking a bit stretched and Fed was looking a bit hawkish. But the base case still remains by that inflation somewhere peaks around, that was prior to this crisis, around June. Now you can extend that by 3 to 6 months, but in next 6 months, you should see peaking of inflation. And as that peaking of inflation happens, I think some of these cyclical should do well. On commodities, we've seen a recent move up. I think we've played commodities for last 2, 3 years, but would be a bit cautious here. And why I say a bit cautious here is we're seeing still weak Chinese property sales. We're seeing inventory accumulation, which is happening in China. So if the net export numbers picks up from China, I think some of these commodity prices can cool off. So we've been bullish commodities for 2 years, but would be a bit more cautious here.
You're turning cautious on commodities, and given all of this uncertainty that we are seeing at the moment, Is it time for the defensives again? Pharmaceuticals, which underperformed last year, IT, which did go through some correction.
So I think clearly defensives would be the place to park your cash for 6 months. And I think in next 6 months, you'll get opportunities in the growth part of the market. Growth here, what I mean is the cyclical recovery part of the market. That would be banks, that would be autos, industrials. I think those would be the names to add for the next cycle, for next 2-3 years.
Okay, defensives it is. But within defensives as well, if I could get a little bit specific here, Rahul, one is seeing one of the first hospital stocks make its entry soon into the index, that's Apollo Hospitals. The street seems a little bit divided about whether or not should you play in for pure play pharma, or whether you should be looking at healthcare services in the backdrop of how some of these stocks have performed and the kind of growth projections that they're sitting at in the post-COVID era.
Okay, so we preferred hospital over the generic pharma companies, and I must say our India funds, our regional funds have got tons of hospital exposure, whether it's India hospital exposure, regional hospital exposure. Our view was, look, should there be a case, a temporary period of a stagflation, which is happening now, these hospitals have good secular demand, they should benefit. They're in a way a reopening play also, that people come back and then they go for these much needed elective surgeries, which are extremely profitable for the hospitals. The valuations were attractive. There was a fair bit of an operating leverage which was going to play out for these hospitals. So we continue to like hospitals here. Selectively, one can look at pharma, but there is a bigger issue which comes of, again, this generic price erosion in US, which kind of and would keep up cap on multiples for the pharma stocks. So between the two, we would still prefer hospitals over pharma names.
Rahul, I go back to that again, inflation demand dynamic. So the fact that inflation is here and demand is slowing down is not tomorrow's trend, it is yesterday's story. Now investing works not by looking at yesterday's story, it works by looking at tomorrow's trend. So the compression in demand and high inflation, how much of this yesterday's trend is something which markets are factoring in? I mean, look at today's market. In the morning when we walked into trade, it appeared that it could have been a 2% or a 2.5% kind of a gap down start. Hopefully we're holding on. The breath is getting better. So my question is that what we're discussing today, how much of that is in the price?
So I think, again, a great point, Nikoj here, because a lot of this is kind of coming through. See, FIs were worried about all this tightening, etc., coming through, and which is why they've been reducing exposure. What happened was, over last 2 months, when FIs were selling, it was domestic, it was retail, it was the HNIs which were buying. So those are not exactly very strong hands. So you need a bit of a capitulation there, and again, like the way we were discussing, hopefully that capitulation happens in next 4 to 8 weeks, and then you will see economic data improve. Then you'll see kind of a stocks prices stabilize. And why I say economic data improve is we are looking at the GDP data for the last quarter. But look, the last quarter was marked by Omicron, all these closing. But as the offices open, as the schools open, there's a fair bit of an economy which is linked to that. Those guys kind of get their wages, they send money back home. The rural economy gets extra income, there the spending starts. So there's a virtuous loop which we believe would play out in next 6 to 9 months. And some bit of inflation is good. See, higher nominal GDP means higher wages, and that money would eventually get consumed because people have not bought any cars, any significant amounts for last 3 to 6 years, etc. So there's a huge pent-up demand in the economy, and that should play out. And then we have government doing all the right things in terms of creating new jobs, which means higher wages. And then obviously that is another set of demand which comes through.
If I speak to Mirae Asset Management, they are bullish on India. If I speak to Samir Arora, on record, he is bullish on India. If I speak to Aberdeen Asset Management, they are bullish on India. If I speak to some other big India dedicated fund managers, they are bullish on India. Then who's selling? I mean, the FI selling is so strong and everybody around us is bullish on India, but somebody is selling. So who are these FIs they're selling? Why are they selling? And is this more a macro and a compulsive trade in nature?
Absolutely. So if you look at, and this is something we were trying to find out. If you look around 2020 October November, there was around 8 to 10 billion which came in that quarter, and nobody could identify where is this money coming from. So the dedicated FIs, they didn't get any significant inflow. So there was a lot of macro money which came into India. Look, India is one of the best reflation stories globally. But look, as Fed tightens, as Fed contracts his balance sheet, obviously the multiple for the market gets impacted. That's been the historical precedence over there, and I think that's where some of the macro money is kind of a moving out. Look, some regional global funds post India's strong performance last year would have taken some money out, tried to put that money in China. But honestly, bottom fishing in China hasn't really helped. The economic recovery is still slow. This whole dynamic COVID policy which they have is impacting economy. So I think that's where, as India gets cheap, as we see the worst of these commodity prices, with the growth certainty which is there in the market from a 2-3 year, with all the good work government is doing, we had no negatives in the budget. It was a very progressive budget. I think FIs will look at India as a secular must-have story.
Rahul, so would you ignore, let's say, the real data which is coming on the demand side, two-wheeler sales, credit growth? The optimistic in me says that, look, this is a blip. But somewhere there is a reality, which this is a real data. The credit offtake has not picked up. Two-wheeler sales, which is an indication of rural demand, that has not picked up. And given that inflationary pressures are around the corner, are we in for not just one, but maybe 2-3 quarters of poor set of earnings?
So absolutely, one would watch this data a lot more closely, because clearly one is a bit worried that why are these numbers not kind of a picking up. At the same time, for every bad data, you have a good data. You look at the monthly GST collections, they continue to surprise. Look, a lot of people have been negative on India that eventually these high crude prices will be passed on to the economy. But what we miss is between 2014 and now, when oil was around these levels, your duties, which is the excise duty on kerosene, on more importantly, petrol, diesel, are nearly doubled. So there is a room government has to cut those excise duty by 30-40% to mitigate some of the pain to the economy. So the view again is that in next 6 months, as things pick up, you should see some of this rural economy doing well. You should see your auto sales go up. At the same time, on a positive data, you look at the real estate numbers. I mean, real estate, we all know, is a very strong multiplier from an economic growth perspective, and those numbers are record high. We look at the quarterly sales, whether it's for DLFs or Prestige, those are extremely encouraging numbers.
Okay, so Rahul, we discussed inflation, the pro-inflation trades that could be done, which you are of the view will not last for more than 6 months. You've talked about this being a time for defensives as well. Another space I would like to talk to you about is financials. Financials underperformed last year. They started to have a good year, the start of 2022, but look at this kind of uncertainty now. Are you still expecting financials to do well?
Okay, so I think over the next 3 to 6 months, you'll get good entry points for financials. Look, if the view is that we are not going to go through this period of hyperinflation, but at the same time, it's not an exceedingly low inflation, rates are going to normalize a bit. These banks get pricing power with a decent GDP, nominal GDP growth. You'll see credit offtake picking up. So right now, what we're seeing is signs of working capital picking up. But then, if we believe in the investment cycle, your demand for new projects should also pick up. So that's good from a financials perspective. Valuations are reasonable. If you look at other parts of the market, consumer discretionary, these companies were at a record gross margins, and they're seeing some bit of a contraction of that gross margins. If you look at these names, staples or discretionary over last 10 years, valuations are double of what they were in 2013-14. So with the global rates normalizing, some bit of a valuation contraction is there, about 1.5 million barrels. And look, near term, we can see oil move up, but like we discussed earlier, it's going to impact the global growth, and what it means, it cools down with the spread of the virus in China. Obviously, if Russia is sanctioned everywhere, not much of the exports can be bought. What can be bought is oil. So I think it's invariably that oil is going to find way to the world markets, whether they supply to China, anywhere else, etc. So from a medium term, a lot of these bottlenecks would be eased. Near term is an uncertainty.
Okay, so let's leave it at that and Good chatting with you, Rahul, especially today when there's so much volatility that we are seeing. It's been a newsy day as well, starting off our morning with the US President Joe Biden's address as far as Ukraine goes, where he said, "Watch out, Putin." With that, ladies and gentlemen, we're going to take a short commercial break, but stay tuned. Coming up on the other side, we'll talk about the auto sector in particular. You started to see sales figures for the month of February come in. We will be touching base with the management of Maruti.